injury. The different auto insurance system. NoFault. The NoFault system is intended to lower the cost of auto insurance by taking small claims out of the courts. Each insurance company compensates its own policyholder for the cost of minor injuries regardless of who was at fault in the accident. The second party is the insurance company and the third is the other party or party is hurt as a result of the accident. These first party benefits, known as personal injury protection, are a mandatory coverage is true. No fault states the extent of coverage varies by state. In state with the most comprehensive benefits, a policyholder receives compensation for medical fees, lost wage, funeral costs, and other out-of-pocket expenses. The major variations involve dollar limits on medical and hospital expenses, funeral and burial expenses, lost income, and the amount to be paid a person hired to perform essential services that an injured non-income producer is unable to perform. Drivers in no-fault states may sue for severe injuries if the case meets conditions. These conditions are known as the tort liability threshold and may be expressed in verbal terms such as death or significant disfigurement, or in dollar amounts of medical bills. Choice no fault. In choice no fault states, drivers may select one of two options: a no fault auto insurance policy or a traditional tort liability policy. In New Jersey and Pennsylvania, the no fault option has a verbal threshold. In Kentucky, there is a monetary threshold. Tort liability. In tradition tort liability states, there are no restrictions on lawsuits. A policyholder involved in a car crash can be used by the car driver and by the other driver's passengers for the pain and suffering the accident caused, as well as for out-of-pocket expenses such as medical costs. Add-on. In add-on states, drivers receive compensation from their own insurance company as they do in no-fault states, but there are no restrictions on lawsuits. The term add-on is used because in the state first-party benefits have been added on the traditional tort liability system. In add-on states, first-party coverage may not be mandatory and the benefits may be lower than in true no-fault states. Regulation. Insurance is regulated by the individual states. The move to modernize insurance regulation is being driven in part by the globalization of insurance services. Some large U.S. companies that operate in other countries support the concept of a federal system that provides one-stop regulatory approval, while others believe the merits of a state system outweigh the virtues of a single national regulator. As a result of discussions about the merits of each system, states are making it easier for insurers to respond quickly to market forces. States monitor insurance companies' solvency, one important function related to the overseeing rate change, rate making in the process of calculating a price to cover the future cost of insurance claims and expenses, including a margin for profit. To establish rates, insurers look at past trends and change in the current environment that may affect potential losses in the future. Rates are not the same as premiums. A rate is the price of a given unit of insurance. The premium represents the total cost of many units. If the price to rebuild a house, the house premium would be. Rates vary according to the likelihood and potential size of loss. Using the example of earthquake, insurance rates would be higher near a fault line and for a brick house, which is more to damage than a frame one. While the regulatory process in each state varies, three principles guide every state: trade regulation system that try to educate to maintain insurance companies' solvency, but no excessive, not so high as to lead to exorbitant profits nor unfairly discriminatory price differences must be reflect expected claim and expense differences. Recently, in auto and home insurance, the twin issues of availability and affordability, which are not explicitly included in the guiding principles, have been assuming greater importance in regulatory decision. In line with these principles, states have adopted various methods of regulating insurance rates, which fall roughly into two categories: prior approval and competitive. This does not mean there is no competition in states using a prior approval system. Most approved rates in prior approval states are the rates used, but in some cases, particularly in commercial coverage, companies compete at rates below these approved ceilings. Regulation modernization increasing even in the most regulated states. Officials are relying on competition among insurance companies to keep rates down and are modernizing and streamlining the rate setting process. The move to modernize insurance regulations is being driven in part by the globalization of insurance services. Some large US companies that operate in other countries support the concept of a federal system that provides one-stop regulatory approval, while others believe the merits of a system of a state system outweigh the virtues of a single national regulator. As a result of discussion about the merits of each system, states are making it easier for insurers to respond quickly to market forces. Since 2009, various pieces of legislation have been introduced in Congress last to respond to a number of concerns. Lack of an entity at the federal level that can present insurance interests, particularly in the discussion of international issues, the need for better oversight of systemic risk in the interconnected of the risk assumed by a few large financial services companies whose failure could bring down the entire financial system, and the need to streamline the regulation of reinsurance and surplus lines insurance. For example, in Georgia, in law was signed in May 2008 that allows auto insurance companies to adjust most rates without the prior approval of the insurance commissioner. Georgia joins at least 30 other states that let rates more closely reflect competition in the marketplace. Types of states rating laws. Prior approval, the insured must file rates, rules, etc. with state regulators depending on the statute. The filing becomes effective when a specified waiting period. If the state regulator does not take specific action on the filing, it is demand approved automatically, or the state regulator formally approves the filing. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance. Modified prior approval. This is hybrid of prior approval and file and use laws. If the rate revision is based solely on a change in loss experience, then expense relationship or rate classification, then prior approval may apply. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance.